Something unusual is occurring in the silver market right now, and very few investors are noticing it. While the mainstream financial media continues to parade a simplistic narrative that inflation automatically equals higher prices for precious metals, a much more complex and potentially hazardous reality is unfolding beneath the surface, prompting us to ask a critical question. Should those holding silver consider exiting their positions? The conventional wisdom that has been drilled into the minds of everyday retail investors is that silver is the ultimate safe haven, a perfect and infallible hedge against rampant currency debasement and the unprecedented liquidity experiment that central banks have been conducting over the past decade. But this deeply held belief ignores the profoundly fragile nature of silver's dual identity as both a monetary asset and an industrial commodity. When we look closely at the macroeconomic frameworks championed by legendary investors like Dalio, we begin to see the severe warning signs of a systemic reset that could violently punish the impatient crowd who have blindly piled into speculative long positions without truly understanding the intricate mechanics of global liquidity. Dalio has repeatedly warned about the changing nature of the global macroeconomic cycle, emphasizing that we are entering a period where the contraction of liquidity and the inevitable balance sheet reduction by major central banks will completely upend the traditional correlations between inflation and asset prices, creating an incredibly dangerous environment where holding the wrong type of hard asset could lead to a painful collapse in personal wealth. The simple inflation equals higher prices retail assumption completely fails to account for the fact that silver is heavily dependent on global manufacturing and industrial output, meaning that as global economic growth begins decelerating and industrial activity is visibly contracting, the fundamental demand for silver in electronics, solar panels, and medical devices will inevitably erode, creating a massive vulnerability for those who are treating the metal strictly as a monetary hedge. This brings us to a terrifying divergence between the reality of the industrial economy and the speculative frenzy of the COMEX futures market, where a massive accumulation of paper contracts has created a precarious situation that could unwind with explosive force if a sudden liquidity shock forces highly leveraged traders to liquidate their holdings to cover massive margin calls. The structural risks inherent in the COMEX paper futures market are often entirely ignored by the average retail investor, who remains fixated on the physical shortage narrative, completely unaware that the price of silver is dictated not by the exchange of physical coins in local bullion shops, but by the high-frequency trading of massive institutional players who will not hesitate to ruthlessly short the market when the macroeconomic cycle turns against industrial commodities. To truly understand the extreme danger of this exact moment in time, we must look back at the devastating historical parallel of the 2011 silver crash, a profoundly cautionary tale that perfectly illustrates how markets aggressively punish universal consensus and how quickly billions of dollars in wealth can be evaporated when a speculative bubble violently bursts. In the lead-up to the 2011 collapse, the exact same narratives we are hearing today were dominating the financial airways, with retail investors absolutely convinced that skyrocketing inflation and central bank money printing would propel silver past $50 an ounce and beyond, only to watch in absolute horror as the market suffered a brutal 50% crash that completely wiped out the portfolios of those who lacked the discipline to understand the broader macroeconomic forces at play. The fear and uncertainty that gripped the market during that painful collapse should serve as a stark and urgent reminder that blindly following the crowd into an overcrowded trade is a recipe for absolute financial disaster, especially when the underlying macroeconomic indicators are signaling a massive contraction in global liquidity that will undoubtedly amplify every downside risk in the industrial sector. Furthermore, we are currently witnessing a massive geopolitical shift that completely undermines the bullish case for silver in the short to medium term. As central banks around the world, particularly those within the BRICS nations, are aggressively accumulating physical gold at record-breaking levels while showing almost zero institutional interest in adding silver to their sovereign reserves. This stark contrast between institutional gold buying and retail silver exposure highlights a critical fiat divergence where the smart money sovereign entities are preparing for a systemic reset by hoarding the ultimate Tier 1 monetary asset, while the everyday retail investor is left holding silver, a highly volatile and industrially dependent metal that will face immense downward pressure as the global economy slips further into a recessionary phase. When central banks engage in currency debasement, they inherently seek the unshakable stability of gold to anchor their balance sheets. Recognizing that silver's dual industrial and monetary nature makes it far too erratic and fragile to serve as a reliable foundation for a new monetary system, especially in a world where global supply chains are fracturing and industrial demand is highly susceptible to sudden macroeconomic shocks. The mainstream narrative constantly points to the green energy transition as a guaranteed catalyst for explosive silver demand, completely ignoring the reality that technological advancements and aggressive thrifting by manufacturers are constantly working to reduce the amount of silver required in solar panels and electric vehicles, meaning that the projected industrial demand could easily fall vastly short of the wildly optimistic projections that are currently propping up the speculative long positions in the market. Meanwhile, the broader monetary system is quietly transforming, and the unprecedented balance sheet reduction currently being executed by the Federal Reserve is actively draining dollars from the global financial system, creating a massive liquidity vacuum that will inevitably trigger a powerful spike in the value of the US dollar, which has historically been absolutely devastating for the price of silver and other industrially sensitive commodities. This contraction of global money supply is the true driver behind the macroeconomic cycle, and the failure of the average investor to recognize this vital dynamic is precisely why so many people will be caught completely off guard when the COMEX futures market experiences a violent unwind, forcing a cascade of liquidations that will drive the paper price of silver down to levels that most currently believe are entirely implausible. Yet this only scratches the surface of the underlying structural problems facing the silver market today, because we must also carefully consider the deeply psychological aspect of investing, particularly the US versus them dynamic that separates the highly disciplined, macro-aware investor from the frantic, impatient crowd that chases momentum and bases their financial decisions on emotional reactions to sensationalist headlines rather than cold, objective data. The disciplined investor understands that markets are inherently designed to transfer wealth from the impatient to the prepared during a systemic reset, and they recognize that holding on to an asset simply because of a dogmatic belief in its intrinsic value, while completely ignoring the overwhelming macroeconomic evidence of an impending liquidity crisis, is an extraordinarily hazardous approach to wealth preservation. Dalio's economic principles remind us that when global debt levels reach historical extremes and the central banks are forced to choose between fighting inflation and saving the economy, they will ultimately induce a massive recession to crush demand, which will severely punish industrial commodities like silver long before the monetary debasement phase can ignite a true sustainable bull market for precious metals. Therefore, the argument that one must hold silver through all conditions is a fundamentally flawed strategy that exposes the investor to an unacceptable level of vulnerability, particularly when the data clearly shows that global manufacturing indicators are already decelerating rapidly, and the speculative long positions in the futures market are dangerously overcrowded, setting the stage for a spectacular collapse that will mirror, or perhaps even exceed, the sheer devastation of the 2011 crash. It is absolutely critical to realize that the massive institutions and hedge funds that dominate the COMEX are not buying silver because they believe in the downfall of the fiat system. They are simply trading the momentum of a macroeconomic cycle, and the very moment their algorithmic models detect a severe contraction in global liquidity, They will instantly flip their positions, triggering a massive wave of short selling that will utterly crush the retail investors who are desperately clinging to their physical coins in the naive hope of an imminent monetary collapse. This is not to say that silver will never have its moment in the sun, but timing and macroeconomic awareness are absolutely everything in the financial markets. And right now, the convergence of historical global debt levels, speculative exhaustion, and a rapidly tightening global monetary policy creates an environment where the downside risks for silver vastly outweigh the potential upside, making it entirely plausible that we are on the precipice of a profound downward repricing of the asset. The feeling of missing out on the macro shift while getting trapped in short-term volatility is a very real danger for those who refuse to adapt their strategies to the changing macroeconomic reality. And it is precisely this fear of financial loss that should motivate every serious investor to take a step back, completely detach themselves from the emotional narratives propagated by silver permabulls, and objectively evaluate the fragile state of the global economy. If we carefully analyze the math of these overcrowded futures trades, we can clearly see that the ratio of paper claims to physical silver is an extreme anomaly. But rather than this being a catalyst for a short squeeze, as the retail crowd desperately hopes, it is actually a massive liability, because when the margin calls inevitably arrive during a broad market liquidity shock, those paper contracts will be dumped onto the market with ruthless efficiency, causing the price to collapse regardless of how tight the physical supply might appear at the local retail level. The disciplined investor must ask themselves if they are truly prepared to endure another brutal, agonizing multi-year bear market in silver, watching their purchasing power erode while other more fundamentally sound assets like gold or even cash provide a much safer harbor during the initial phases of the systemic reset. We must look past the simple, comforting lies told by those who have a vested interest in selling physical bullion to retail investors. And we must acknowledge the harsh reality that the macroeconomic cycle is turning exceptionally hostile toward industrial commodities, meaning that the highly anticipated explosive breakout in silver prices is incredibly likely to be delayed until after a massive deflationary shock has completely wiped out the current speculative excess in the system. As we navigate this unprecedented economic environment, we must remember that true wealth preservation requires a deep understanding of how global liquidity flows dictate asset prices. And we cannot afford to be blinded by the romanticized notion of silver as the people's money, when the sovereign powers of the world are actively demonstrating through their actions that gold is the only monetary asset they truly trust to survive the coming fiat divergence. The central banks of the BRICS nations are not stockpiling silver to back their potential new trade currencies. They are buying gold by the ton. And this profound lack of institutional monetary demand for silver is a glaring warning sign that should make any rational investor seriously reconsider their heavy exposure to an asset that is so deeply misunderstood by the general public. To ignore these massive geopolitical and macroeconomic shifts is to invite absolute financial ruin, because the markets do not care about your personal beliefs or your ideological attachment to a particular metal. The markets only care about the flow of capital. And right now, the capital is signaling a massive retreat from the riskier, more volatile assets in preparation for a period of extreme economic hardship and intense financial uncertainty. The 2011 crash proved definitively that when the liquidity evaporates, the fundamentals of physical supply and demand are completely overridden by the sheer panic of the paper markets. And we are currently setting up for a scenario that looks terrifyingly similar, complete with an overconfident retail crowd, a fundamentally weak industrial backdrop, and a central bank that is actively draining the lifeblood of liquidity from the global financial system. Therefore, the idea of stepping aside, taking profits, or at the very least dramatically reducing one's exposure to silver in the face of these overwhelmingly negative macroeconomic indicators is not an act of cowardice, but an act of extreme financial prudence and disciplined risk management perfectly aligned with the strategies employed by the most successful macro investors in the world who understand that preserving capital during a liquidity contraction is far more important than trying to catch the absolute bottom of a falling knife. You do not want to be the impatient retail investor who gets caught holding the bag when the COMEX futures market violently unwinds, watching helplessly as the value of your portfolio is decimated simply because you refuse to acknowledge the reality of the macroeconomic cycle and the dual industrial nature of the asset you were holding. Ultimately, navigating the coming volatility and surviving the impending systemic reset will require much more than a simplistic buy and hold strategy based on a fundamental misunderstanding of how inflation and liquidity interact. It will require deep macroeconomic awareness, intense psychological discipline, and the willingness to make difficult, contrarian decisions that go against the grain of popular opinion in order to protect your hard-earned wealth from the brutal realities of the global financial system. The most valuable strategy in these conditions is patience paired with awareness.